In late September, Xi Jinping finally abandoned his earlier approach of strengthening economic foundation and shifted his stance on China's economy, initiating a market rescue effort. After this policy was announced, China's stock market experienced a roller coaster ride. Ahead of National Day, news of large-scale stimulus policies sparked a rapid surge in China's stock market. On October 7th, the market saw a near-limit up rally shortly after opening, but by afternoon it faced a sharp decline, with the Shanghai Composite Index now stabilizing around the 3,200-point level. Some attribute the recent stock market fluctuations in China to a ploy by the Communist Party to lure investors for profit-taking, while others see the market's failed rally as a sign that Xi Jinping's rescue plan is faltering. However, I don't agree with either view. So how should we truly interpret Xi Jinping's current rescue strategy and the ongoing volatility in China's stock market? Hi, I'm Dongxiang. Welcome to Digging into China, where we take a deeper look at China to reveal insights you can rarely find anywhere else. In this session, I'll take another look at Xi Jinping's market rescue plan and discuss why the stock market has been so volatile, showing such strange trends. First and foremost, it's evident that the recent rise in China's stock market was not due to an economic recovery, but rather driven by policy stimulus. This surge is directly linked to the strength of current policies. Leading up to October 8th, the market continued to climb due to robust expectations surrounding these policies. Following Xi Jinping's announcement of stimulus measures in late September, reports from Bloomberg, Reuters, and various domestic media outlets fostered the impression that a significant stimulus package was on the horizon, intensifying market enthusiasm at that time. At the time, both inside and outside of China, there was widespread talk of 10 trillion yuan rescue package, with the speculation that Xi Jinping might replicate the scale of Wen Jiabao's previous 4 trillion yuan rescue plan. This expectation of a large-scale stimulus created a promising opportunity for investors. If such a massive stimulus policy were truly on the way, entering the stock market would indeed be a wise choice, as historically, China's stock market has seen major upswings following large-scale stimulus policies. In fact, China's last 3 bull markets were primarily driven by such policy-led measures. In recent years, China has seen 3 major rounds of stimulus policies. Wen Jiabao's 4 trillion yuan plan in 2008, followed by 2 rounds of monetary easing under Xi Jinping in 2014 and 2020. Each of these stimulus waves brought a modest peak in the stock market. Although these increases haven't restored the market to its pre-2008 heights, each round of stimulus led to a doubling of the CSI 300 index during those periods. For many, particularly professional investors, buying into the stock market at this stage seemed sound. So why did the market's performance ultimately disappoint? It's a case of policy being both the catalyst and the setback. The anticipated large-scale stimulus that had generated such excitement never actually arrived. Reflecting on China's stock market on the morning of October 8, it initially surged close to the 10% upper limit after opening. However, the rally soon lost steam, with the day's gains settling at 4.59%. At the same time, the Hang Seng Index recorded one of its steepest single-day declines in recent years, dropping by 9.4%. If you follow the stock market's movements that day, you will notice they closely mirrored the announcements from the National Development and Reform Commission's, aka NDRC, October press conference. When the NDRC offered vague statements, the market dipped. When specific stimulus figures were mentioned, the market rallied. Ultimately, however, the announcements fell well short of expectations, delivering just 200 billion yuan in real funds with no other substantial stimulus measures, far from the anticipated 10 trillion yuan. Consequently, the A shares dropped sharply the next day with a single-day decline of 6.62%. The sharp downturn took many prominent stock market commentators by surprise. Analysts across China had been discussing the situation in depth, so why did no one anticipate such a substantial drop? Simply put, few expected the stimulus policy to be so underwhelming, big talk with little action. This even led some to question whether the central government's apparent shift towards market rescue was sincere or just a bluff. After the market plunge, Bloomberg criticized the Chinese officials, suggesting they need to learn how to communicate in ways that align with market expectations. However, during a press conference on October 12th, Minister of Finance Lan Fo-an intervened to stabilize the situation. While the conference succeeded in halting the A-shares' continued decline, it merely stopped the downward trend without reversing it. And this was primarily because the press conference offered little in terms of substantial announcements. The important takeaway, however, was that during the press conference, Lan Fo-an clarified why the current policies had not met expectations. It wasn't due to the central government merely pretending to shift its stance. Instead, he indicated that additional policies were being prepared. He emphasized that the government's commitment to a change in policy was clear and unchanged, assuring everyone that a more accommodative monetary policy would indeed be on the way. So there was no need for alarm. While this may not align with the stimulus policies that the capital markets were hoping for, Lan Fo-an's comments effectively stabilized investor confidence, far better than the earlier statements from the NDRC. This likely accounts for the recent fluctuations in China's stock market and why it has managed to maintain a position around the 2,200 points mark. How should we assess the market rescue policy considering its current results? Why has there been a prolonged delay in announcing specific stimulus measures? Does the current situation suggest that Xi Jinping's initiatives in this area have already hit a wall? First, I don't understand why major investment institutions like Nomura, JP Morgan Chase, and Morgan Stanley would imagine that China would introduce a 10 trillion yuan plan primarily focused on stimulating consumption. Such expectations are fundamentally unrealistic. While Xi Jinping has acknowledged the current issues facing the Chinese economy, he has not altered his approach to economic development. His focus on supporting emerging sectors and high-tech products remains unchanged. In this context, it is simply impossible to allocate 10 trillion yuan, much less use it to stimulate consumption. While I have always thought that Xi Jinping would never launch a stimulus policy as large as 10 trillion yuan, I didn't expect his policies to turn out this way, lacking any substantial plans or significant scale. This realization has led me to acknowledge that I had previously overestimated Xi Jinping. The current state of policy implementation indicates that Xi Jinping's grip on China is not as strong as many anticipated. At least for now, he may be weaker than during the Hu Wen era. This perspective may be puzzling to some. When it comes to concentration of power, Xi is indeed one of the most powerful general secretaries in history, far surpassing Hu Jintao, not to mention Zhao Ziyang and Hu Yaobang. Indeed, it is considerably easier for Xi to remove an official or a business leader than it was during the Hu Wen period. But why does this situation suggest that his control is weaker than during the Hu Wen era? And this is because the ability to manage power and to govern China are two distinct issues. If Xi's control was sufficiently strong, we would expect to see a response similar to Wen Jiabao's announcement of the 4 trillion yuan stimulus policy back in the day. On November 5, 2008, Wen Jiabao publicly announced a decision to implement a 4 trillion yuan stimulus plan. Just 4 days later, on November 9th, the State Council promptly unveiled the specific measures to support this initiative without evaluating the merits of the 4 trillion yuan plan. It is notable that the time between the announcement and the implementation of concrete measures was only 5 days, showcasing both remarkable speed and a smooth, cohesive process. Moreover, following the announcement, the central decision-making bodies presented a facade of unity, and the various departments maintained a clear consistency in their actions. In stark contrast, it is evident that the current Communist Party of China is finding it increasingly difficult to make coherent and consistent decisions. First, after the announcement of this market rescue plan, we can see a considerable degree of confusion among the involved institutions. In China, the three main agencies that serve the economy are the National Development and the Reform Commission, the Central Bank, and the Ministry of Finance. However, significant discord has arisen from these three agencies during this collaboration. At the end of September, Central Bank Governor Pan Gongsheng ignited market enthusiasm by announcing the launch of the rescue policy. However, shortly afterward, on October 8th, the NDRC had held a press conference that came off as insincere and filled with nonsensical statements. This was followed by a Ministry of Finance press conference on October 12th, which presented only slogans and offered no substantial measures. As of now, it has been a month since the initial announcement of a market rescue, but the details regarding the scale of the rescue remain vague. This is a stark contrast to the decisive and swift actions seen during the Hu era. The policy formulation has lost its previous coherence, with various departments seemingly working in isolation and lacking coordination, highlighting a chaotic decision-making process at the central level. This kind of chaos is apparent not only within the bureaucratic system but also in the realms of private capital. While Xi Jinping's tenure has seen unprecedented control over capitalists, his actual influence in mobilizing capital has noticeably declined. After Xi Jinping urged increased investment in the stock market, a significant wave of capital withdrawal among investors occurred. On the day of the announcement, A shares experienced a large-scale sell-off. Between September 23rd and September 30, 87 companies in A share market reduced their holdings, which was double the number from the previous week. Additionally, on October 8th and 9th, right after National Day holiday, when the market reopened, A shares set new records for shareholder sell-offs, with 33 companies reducing their holdings on October 8th and 38 companies doing so on October 9th. Moreover, looking at the fund flows, it is evident that although net outflows of major capital have been the norm, the last 2 days have set new records for these outflows. When President Xi Jinping launched this market rescue initiative, he likely aimed to inspire capital to invest heavily, fostering faith in the Communist Party and the future of China. Yet, the result has been a mass exodus of capital, leaving only a bunch of retail investors celebrating in a futile frenzy. What's even more concerning is that many investors are using loans to trade stocks, forcing the Communist Party to quickly impose regulations against this practice. The market appears to have strayed from Xi Jinping's expectations and control. Additionally, beyond these two factors, the current situation in China has effectively constrained Xi, making it difficult to roll out substantial stimulus policies. The leadership of the Communist Party is currently attempting to uphold discipline regarding government deficits. Since 2019, China has experienced the highest growth in public debt among major economies, excluding local government debts that remain largely unassessed by the party. Implementing a large-scale stimulus policy would undoubtedly heighten debt risks, further limiting the party's flexibility in policy making. Moreover, the external environment is becoming increasingly unfavorable for the Communist Party to implement large-scale market support measures. Besides issuing substantial debt, one common approach to stimulus is lowering interest rates. However, China's ability to cut rates is significantly influenced by US interest rates. For instance, if US rates are at 5% while China's are only 2% or lower, it would likely lead to a significant capital outflows from China to the US. Investors tend to seek higher returns, especially when the US has stronger creditworthiness. Additionally, recent robust economic growth in the US has reduced the urgency for the Federal Reserve to lower rates this year, further constraining China's ability to make similar cuts. Additionally, external pressures on China are intensifying. Recently, the EU, Canada, US, Russia, and Brazil have increased the tariffs on Chinese electric vehicles. Currently, China's greatest concern is the potential return of someone like Trump. He has threatened to impose a 60% tariff on all Chinese products if he regains power, which would significantly impact China's economy. This uncertainty complicates the central government's ability to define a specific scale for stimulus measures. If Trump were to take decisive action, even a 1 or 2 trillion yuan stimulus might not be sufficient. Currently, Xi Jinping is grappling with a situation that is significantly more challenging than what Hu and Wan faced. Despite successfully consolidating power, imposing speech restrictions, and regulating capitalists, the problems arising from centralized authority and the long-term rule of the Communist Party are becoming apparent. This centralization has caused disorder within the bureaucratic system, while strict control of capitalists has complicated efforts to coordinate their activities. Despite Xi Jinping's long-standing anti-corruption campaign, the issue of bureaucratic redundancy remains unresolved. The recent collapse of land financing has further exacerbated the government's mounting debt. Additionally, the external environment is growing increasingly hostile, with reduced expectations for US interest rate cuts and adversarial relations globally. Xi likely longs for the Obama years. The stance taken towards China during the Hu era was considerably more favorable than under Trump, and even more so compared to Biden. These factors collectively contributed to the significant challenges Xi faces in rolling out effective stimulus policies. I can make a prediction. After Finance Minister Lan Feng's speech, it is clear that Xi Jinping's stimulus plan will not be abandoned. It is merely facing delays and has not yet fallen through. The specific scale of the stimulus is generally anticipated to be unveiled during the 2024 National People's Congress Standing Committee meeting, similar to last year's timeline. On October 24, 2023, the final day of the National People's Congress Standing Committee, a quota of 1 trillion yuan in additional sovereign bonds was approved. This raises the question of the scale of the current stimulus package. Many believe that the decision will likely be made during this year's routine session of the National People's Congress Standing Committee. However, this meeting, initially expected to occur in the past few days, has reportedly been postponed until November. The delay is primarily due to the upcoming US elections. If Trump is re-elected, China may need to implement more aggressive stimulus measures in response to potential tariffs. I've always thought that Xi Jinping's market rescue plan wouldn't be able to reverse the long-term decline of the Chinese economy. However, it's too early to declare that the plan has already failed. We likely won't see the actual rescue plan until November or December, when the complete version is expected to be unveiled. Only then can we properly assess this impact on the Chinese economy. Thank you so much for watching. If you find this video helpful, please like it, drop a comment below, and hit the subscribe button right here. It really helps YouTube suggest my video to others. I'll be back with more content soon. Until then, stay well.